Just a reminder, nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Hello guys, and welcome back to a new month. With that, let's take a look at the new monthly statistics. Here we have the stats for March. Based on historical data, the month slightly favors a bearish close. However, considering that this move has been slowly exhausting and that we haven't seen any real retrace from a monthly perspective, things get interesting. Price has already dropped over 50% at one point, so naturally, at some stage, we can expect a positive month to print. The question is not if a green month can happen, but how strong it would be. For example, what would clearly be bullish is if this monthly candle closes above the previous one. In that case, we would target higher prices without a doubt, likely around the quarterly S level. But until that happens, I have to focus on what is happening on the lower time frames. Currently, price is in a range, and we have a new monthly open to work with. Looking at the averages, we can see that the bullish monthly average move is around 37%. That is not a small move. If we project that onto the chart, it sits around 92K. As it stands right now, I'm not aiming for that level this month. However, I also need to understand that it is possible, because that's exactly what averages represent. I use these statistics to define data-driven levels for the month, not random expectations by pulling Fibonacci levels or anything else. These are statistical data points that are possible. But our job is to observe what is happening locally and assess whether price action can realistically reach those levels. So yes, the monthly average gain is possible, but I am not expecting it right now. Next, we have the average bearish monthly wick. That means in bearish months, price tends to rise around this average level, then reject and form the high of the month. That scenario is currently more realistic, especially because this level aligns with other resistance levels. That gives us confluence. On the downside, we have the average bearish monthly close of around 13%. If we project that onto the chart, it would result in a relatively shallow move down. It would look more like the previous bottom formation, where price slowly curved rather than dropping impulsively. But as long as the month hasn't closed there, it could also become a potential SFP-type area, meaning price dips below the low, sweeps liquidity, and then closes back higher. For the bullish monthly wick, which averages around 8% from the open, that level currently sits around 61.5K. That means in a bullish month, price could wick down to that area and then rise. So overall, the monthly averages suggest that even if a move happens to the downside, it's statistically more of a shallow one. Of course, statistics are not predictions. We are working with historical data. That doesn't mean we can't get new data that moves far beyond previous highs or much lower than expected. If that happens, I will simply adjust the statistics and move forward. Until then, I work with what I have. One more important point on the monthly time frame. Price has now broken monthly structure. To be honest, that has only happened once before in Bitcoin's history, so there isn't much data to compare. The last time it happened, price formed a lower high and another low. But it was more of a slow sideways to down slowdown rather than an impulsive collapse. What that tells us is that after a monthly bearish break, price was actually already starting a bottom formation process. And here we are again with another monthly break. Technically, that means we should look for a lower high until proven otherwise. It would be invalidated by either making a new low and then breaking structure back up, or by reclaiming the all-time high. Until that happens, technically and structurally, you look for a lower high or potentially an SFP of the swing high. But an SFP of the swing high would mean a new all-time high, which at this point is not the primary bearish scenario. That scenario would only come back into play if price starts rising nonstop from here into a new all-time high. Now let's talk about timing. On average, both uptrends and downtrends tend to establish their key high or low early in the month. In a bullish month, the low often forms early and the high forms later. In a bearish month, it's the opposite. The high forms early and the low comes later. Right now, price is clearly in a downtrend. So technically, we would focus on the downtrend timing model. That would mean we see a rise from here toward resistance, whether that's the range high or one of the monthly average levels, and then a retrace that forms the monthly low later. If the month turns bullish instead, we would simply see price continue higher. That would be new data, and we would adjust accordingly on the way up. If it turns out like last month, where both the expected time windows for the high and low are reached without major continuation, then expectations shift toward a range, no new major high or low. The new month has just opened, so now we need to watch the first movements carefully and see which targets are hit during the first average timing window. Now let's take a look at the next chart. Next, we have the 202-day cycle that we marked out and have been waiting on since March 2nd. Yesterday, that timing window was reached, and now we are seeing a reaction from that level. Of course, this does not automatically mean that price will fully shift from here. As explained before, price could also move sideways or even push slightly higher and then reach the next important timing window, which aligns more closely with the 4-year cycle low. If we see a rise or extended sideways movement into that timing window, I will also reference my other chart showing historical bottoms and where they formed relative to time. As you can see, the structural floor is rising over time. Logically, that would be the area to look for a potential macro bottom. However, if price continues to range sideways for an extended period, the drop into the 4-year cycle low could actually become a higher low scenario instead of a full breakdown. Personally, I am fine even if price touches the lower levels below us. But realistically, I need to go step by step and not simply hope that those levels will be tagged. To make this easier to understand, it could play out in a few different ways. Price forms the low now and only later hits the projected level. We have seen that multiple times historically. Price forms a low before the cycle date, then retests that level later but forms a higher low. Price retests the level and makes only a slight lower low, with that macro level ultimately holding. So a lot depends on how long price spends ranging. Historically, if price drifts lower relatively quickly, a slight lower low is still possible. But the more time passes without a breakdown, the less likely a deep move becomes. Time is an important variable here. We remain open to all scenarios. For me, the goal is always to act based on what I believe is correct according to the data, even if that sometimes means being wrong. If I am wrong, I will say it openly. There is no point in hiding that. As it stands right now, nothing has changed regarding the current lows. I would only expect a move towards significantly lower levels if the range breaks down. And that brings us to the local levels. On the yearly Fibonacci price time chart, we were watching this yearly Fib time level where we expected volatility. And that's exactly what we got. We saw an aggressive move down into support, followed by a bounce. The bounce came back up into the SR level and into the circles I marked out earlier. If you remember, I talked about that circle when price hit that level on the very first day after I drew it. I said that this circle needed to be watched closely because price was more or less trapped between those levels. Below it, we could see a grind down. If it broke back above, we should treat it as support. Yesterday was actually the first daily candle that clearly broke back above that level. We can see it was respected nicely, and since it broke upward on the retest, I can now look at that level as support, until proven otherwise. I'm not trading directly from this chart. I use it as confluence. Over time, you'll see how helpful this is, and it's actually very simple to use. If one level gets reclaimed, look toward the next one. If one level gets lost, watch the next lower one. Always observe where price meets time on the yearly Fib time levels. For example, the next important timing level is toward the end of March, which also aligns with the monthly close and the quarterly close. That adds significance. So if price keeps ranging here, whether we see another leg up toward the range high or more chopping around this circle, the main focus for larger moves should be around those Fib time windows. At the lows, we want to see price hit support levels into the timing window. At resistance, if price is rising into a key price level and the time window aligns, that's where we look for volatility or a potential reversal. Right now, price is broken above the circles, So for now, on this chart, I'm looking at this confluence level here as support, along with the time trend line. Because as we can see, price is forming higher lows along that line. Only if that level gets lost would I look toward the next lower level, or alternatively, look for signs of strength by reclaiming the broken level again. On the upside, in a best-case scenario, price would need a clean break above this resistance level. If that happens, I would then aim for the range high to be taken. And that brings us to the local range. These are the local levels we currently have, a clear range. Inside this range, we have a defined high and low, both with nice confluence. The range high aligns with the previous monthly value area high, and the range low aligns with structural stop levels and the monthly average wick. That makes the low a strong area of interest for me. Below the range low, we have the overall macro low and the monthly bearish average close levels. That would be the next significant area where I would look for potential trade opportunities. For now, I am longing within this range because I expect a low to form somewhere in this structure. For the next trades, I would prefer to see either the lower levels or the upper levels touched, not the middle. At the range high, we have the value area high as confluence. That's also a strong level. So if price pushes up again into that area, I will look for a setup there and simply continue treating this as a range. If price breaks above the range high, then I would look toward the next higher level, which is the monthly average wick for a bearish month, combined with a higher time frame SR level. That would become the next area of interest. So as you can see, we already have several levels mapped out. The range itself, the scenario if price breaks above, the scenario if price breaks below. Inside the middle of the range, I'm not too interested unless it's a specific level where I want involvement. Today, price moved higher and formed a daily SR level around the mid-range. Interestingly, the weekly open sits at the low of that level, and the monthly open sits at the high of it. That makes this current zone important for observing strength or weakness. If price pulls back into that level, I will look for a reaction, not necessarily for a trade, but for information. As mentioned before, my main action levels are either below the range or above it. However, since I have running trades, I also want to monitor when probabilities increase toward one direction. This mid-range SR level helps with that. If price holds above it, that suggests support and increases the probability of higher prices. I don't need a new setup. I can simply stay in my longs and let them run. If this level gets lost, then I can look toward the lower range levels. That may allow me to secure more profit on running longs, potentially re-enter lower, and also plan the next profit-taking zone for shorts. This level can absolutely be traded. I have used it before for short take profits and even for longs. But right now, since I already have a better long from lower levels, I don't see a reason to enter in the middle of the range. With new data coming in, we adjust the plan. So far, price is ranging, which was expected since the first days after the drop. Since then, we've received new information about the structure of this range and slowly adjusted the plan based on evolving scenarios. A perfect range scenario would be something like this. Take out the high, then form either a higher low or an SFP of the low, and then reverse. A higher low would be preferred, especially if time continues to pass, as shown earlier on the power law chart. For today, what I'm watching is simple. If price rises, great. I don't need to do anything. If price ranges and closes the day red here, I need to watch what the next day brings. The reason is that price made a strong move up and is currently at resistance, so some rejection is natural. What we often see when price leaves a range is the formation of an SR level or order block. I call these range breakers. That means if price wants to go higher, it may consolidate just below resistance, trap more shorts, and then the next day prints a strong bullish candle with a breakout. That's the ideal scenario. In many cases, it can still end in chop, but the clean version is consolidation, formation of an SR level, and then expansion upward. That SR level then becomes useful later. If price rejects, we treat it as resistance. If reclaimed, we treat it as support. If lost again, we look lower. The same applies to the SR level we marked earlier. It may become important later, or immediately. For example, if price drops into it now, we look for support. But in the bearish case, if we see an aggressive move below that level and a daily close underneath, then the probability increases that the next move will reject from that level and push price toward lower targets, unless it turns into some choppy trap. This is exactly why there is too much going on in the middle of the range right now. That's why I'm not very interested in getting involved at the midpoint. I would rather wait for the lower levels or the higher levels to be tested. Now, let's look at the averages for today. Based on the averages, we could potentially see a new high today. That would create a possible SFP of Monday's high. Personally, I'm not looking for a short from here since I already have one from higher levels. But that area provides confluence for anyone looking for a take profit or a short setup. On the downside, the average daily loss projection would sit above the monthly open. Even a wick down into the support level would be completely fine structurally. That could serve as a potential take profit for someone holding a local short and also as a level to watch for a reaction. For me personally, I'm not interested in trading those intraday levels right now because I already have running trades. So instead of forcing something new, I'm focusing on managing existing positions. Now let's move on to the trades. The long that was shared is still running. I've been consistently updating how I'm managing that trade, so if you're here to learn and not just to look at charts, I hope you're getting value from that process. My next take profit area is slightly higher, around 71K and the range high. Once price reaches that zone, I'll start looking for short opportunities, level by level. If price comes back down from there, I'll close a bit more of the long and potentially use that capital to re-enter if the lows get taken out. Same process as always, level by level, step by step. So overall, not much has changed. We have a few new monthly levels to monitor, but the bigger areas remain the same. The range plan remains the same. After that, you can choose your pain. Either the range holds and we continue building structure, or we get the historical type move similar to the 80% drawdown scenario, which would break some of the current metrics. Either way, we are likely to see something new this cycle. I hope that was helpful. If you have any questions, let me know. Until then, I wish you a great day, and I'll see you in the next one.